Investing is all about balancing risk and reward, and dopamine hits. We all know that the more risk we take on, the higher the potential rewards are. But when it comes to risk, time is also working against you. Because higher risk strategies are great when they work, but they're not likely to be replicable in the future. So the more time passes, the lower the total rewards are going to be. Unless you're this guy. Let's say you want to use at-the-money call debit spreads to double your portfolio. Let's say you've got a 50% chance of success. And let's say you actually make money on your first attempt. Enjoy the dopamine while it lasts. Now, succeeding twice in a row, your chances have just gone down to 25%, while your chances of succeeding 3 times in a row are 12.5%, and so on. What's fun about buying options is that there are ways to move the odds in your favor, like closing your positions before they exceed a 50 or 75% loss, using technical analysis. But the more time you spend doing this, the more you realize that buying options is extremely analogous to gambling. Because unlike actually owning shares of stock, if your positions turn against you, you may not even have a bag left to hold. Maybe you're taking a dump and you left your phone in the other room, and by the time you get back to your desk, you've already lost 99% of your portfolio value. I mean, come on, you know for a fact this has happened to someone out there. Anyway, let's talk about debit spreads. Debit spreads are directional bets. If you're wrong on which direction the underlying stock is going to move, you basically lose your investment. When done correctly, managing before a total loss can help improve your odds when gambling with option buying strategies. But I don't do any of that because I'm lazy and it's too much work. And I'm a coward. If a spread doesn't go your way, there are ways to unfuck yourself. You can roll the positions, or if you think the trend has reversed, you can take the opposite side of the trade, and so on. There are basically 2 types of spreads. If you're bullish, you can enter a call debit spread to capitalize on an upward move in the underlying stock, and if you're bearish, you can buy a put debit spread. If you're staying near the money, these more or less tend to be double or nothing sorts of deals, which is why I always compare buying options to gambling. The similarities are just uncanny. Here's an example of an at-the-money call debit spread on GameStop. If you think the price is going to rise, you could enter a 50-cent wide call debit spread by buying the $23 strike and selling the $23.50 strike. If you end up paying $30 to enter this position, your max profit is going to be $20. That's a 66.7% return in 8 days. Not bad. If you annualize this return, like an absolute crackhead, you'll note that you could potentially make over 3,000%, obviously not factoring in the effects of compounding. If you actually compounded a 66.7% gain every 8 days, this is what your annual growth factor would be, meaning that your investment would multiply by about 13.36 billion over the course of a year. In percentage terms, that's roughly 1.3 trillion percent. If you think a stock's price is going to fall, you can instead buy an at-the-money put debit spread. As you can see, it's kind of a double or nothing sort of deal. In this case, you'll either make or lose about $25. Now, if you really think highly of yourself, you can combine a call debit spread and a put debit spread into a long condor, a position that can benefit whether the underlying stock rises or falls, assuming the price change is big enough to get past the inner strike prices. It's like the old gambling saying goes,
2 legs are better than 1.
Let's take a look at a long condor on GameStop. As you can see, you're basically betting on volatile price action happening. So if GameStop stays put, you're kinda fucked. Someone call Kitty and tell him to start posting again. Besides being directionally agnostic, long condors have another cool benefit. They let you profit in 2 different scenarios, using half the collateral you'd need compared to if you were to separately open a call debit spread and a put debit spread. This is because your brokerage recognizes that the underlying stock can't expire in 2 different areas at once, meaning that only one of the wings of your condor can be exercised. A short condor is profitable if the stock does nothing. It's basically the opposite of a long condor. It's betting against volatility, which just kind of feels like a bad idea right now. Some of you may feel like these strategies all seem reasonable enough, but let's say you've had a bad day at work, are a little intoxicated, and have decided, fuck it. If you've stuck with me this far, let's face it, you're a bit of a degenerate. You've got a bit of that dog in you. So let's talk about buying call options on GameStop.
Alright, Brain. You don't like me and I don't like you.
Full disclosure, I'm not really into GameStop, but I respect the hustle. Now just looking at this chart, I can see why some people think this thing could potentially shoot back up to 29 or 30 bucks a share. Today's July 17th, so let's give ourselves at least a month for this to play out. I know GameStop enjoyers are probably hurting pretty bad right now since virtually the entire market except for GameStop has seen a V-shaped recovery, and at this point I don't think there's anything in the big beautiful bill about subsidizing GameStop using taxpayer dollars, so personally, I probably won't be indulging in this trade. GameStop is currently trading at $23.43 a share. If you were to buy a call option with a $24 strike expiring about a month from now, it would run you about $105 per contract. We've been hitting the crack pipe pretty hard, so let's say we're just gonna go ahead and buy 100 of these bad boys for a total cost of $10,500. As you can see, our max profit at expiration is $695 per contract, or $69,500. Not bad for clicking a few buttons on your phone after a long day of huffing glue. But if GME falls below the strike by expiration, you just lost the equivalent of a fake Rolex, or about 20,000 helpings of top ramen. So you're completely fucked, and you'd be lucky to walk away with just a scrap of extrinsic value. Obviously, I'm kidding. We all know this isn't a trade you make expecting to walk away from. It's all or nothing. If aping into GameStop calls sounds like a Tuesday afternoon for you, I've got an even more ill-advised play, which is aggressively buying puts on companies everyone likes. I came across a guy on Wall Street Bets a while ago, Maye76. I talked about him in a previous video because he lost $1 million betting against Nvidia. Oh sure, he had what he thought was due diligence and a narrative, one that he could even support with dubious information cobbled together from other contrarians. If you half-assedly slop together various data points in a feeble attempt to connect the dots with the goal of calling the supremacy of Jensen Huang among tech CEOs into question, you're gonna have a bad time, because if you come for the king, you best not miss. And did Maye76 miss? The answer is of course yes, ladies and gentlemen. He missed. He missed bigly. This is what his portfolio looked like by the time he got done aping into puts like a straight up brainlet. If you're not initiated in the dark arts of option trading, you may be thinking to yourself, how? How is it possible to lose that much money that quickly? It's all thanks to one of the fundamental features of options. They can end up worthless at expiration. A put option gives you the right, but not the obligation, to sell 100 shares of the underlying security at a strike price. So if the stock price rises above the strike, your option will basically expire worthless. If you're lucky enough to have the underlying stock price move against you before expiration, you may have a chance to slink away with just a morsel of whatever extrinsic value wasn't melted away by theta decay. Too many people out here are just straight up contrarians. However good you think your due diligence is, it's probably half as good as that. It helps to think of your due diligence as one of those horrible doodles you made in elementary school that your parents hung up on the fridge to not hurt your feelings. I say this with love, but stop buying fucking puts, and I'll see you in the next one. Bye for now.
I don't like them putting chemicals in the water that turn the friggin' frogs gay. Do you understand that? Serious crap. I never sucked any ding-dongs. Never defeat the human spirit. You